Remember that time you left a carton of milk out on the counter, went on a weekend trip, and came back to a science experiment? That's kind of what happened to Silicon Valley Bank. Except instead of spoiled milk, we're talking billions of dollars. One minute, it was the darling of the tech industry, funding startups and making dreams come true. The next, it was gone. Vanished faster than a Bitcoin bro at a financial literacy seminar. People were freaking out. Politicians were pointing fingers. And your uncle, who still thinks Bitcoin is a type of bird, was suddenly an expert on financial regulation. It was chaos, pure and simple. But how did we get here? Buckle up, because we're about to dive deep into the wild world of banking, tech, and what happens when those two worlds collide. Silicon Valley Bank. It sounds like the name of a fictional bank in a movie about, well, Silicon Valley. And in a way, it was. Founded in 1983, SVB quickly became the go-to bank for tech startups and venture capitalists. They were the cool kids on the block, the ones who understood the language of IPOs, burn rates, and unicorn valuations. They were the financial fuel that powered the tech boom. But like a lot of things in the tech world, SVB's success was built on a foundation of risk. They poured money into high-growth, high-risk startups, hoping for a big payoff. And for a while it worked. But then interest rates went up, the tech bubble started to wobble, and suddenly, SVB's risky bets weren't looking so hot. The rest, as they say, is history. A history that involves a bank run, a government bailout, and a whole lot of questions about what went wrong and who's to blame. Remember that game you played as a kid where you'd line up dominoes and then knock them all down with one push? That's kind of what happened after SVB went belly up. The collapse of one bank, even a big one, shouldn't have sent shockwaves through the entire financial system. But that's exactly what happened. Why? Because in the interconnected world of global finance, everything is connected. Banks lend to each other, investors get spooked, and suddenly, a problem in Silicon Valley is a problem for everyone. The SVB collapse exposed the cracks in the system, the vulnerabilities that had been building for years. It showed us that even the biggest, most established institutions can be brought down by bad bets and a lack of oversight. Government bailouts. The financial equivalent of finding a $20 bill in your pocket, except instead of being happy, everyone's arguing about where the money came from and who deserves it. When SVB went under, the government was faced with a tough choice: bail them out and risk moral hazard. That's economist speak for encouraging bad behavior, or let them fail and risk a full-blown financial meltdown. In the end, they chose to bail out the depositors, but not the bank itself. It was a controversial move, with critics on both sides screaming bloody murder. But it highlighted a fundamental question: what role should the government play in regulating the financial industry? And how do we prevent these kinds of crises from happening in the first place? Section 5. Lessons learned. Maybe? Tech companies and banks scramble for cover. So, after the dust settled and the bankers stopped hyperventilating, did anyone actually learn anything from the SVB debacle? The answer, my friends, is a resounding maybe. Tech companies, burned by their reliance on a single bank, started diversifying their cash, spreading it out among multiple institutions like a bunch of squirrels hiding nuts for the winter. Banks, suddenly aware of the dangers of loading up on risky assets, who knew, started tightening their lending standards and shoring up their balance sheets. The problem is, these are all reactive measures. They're like putting on your seatbelt after you've already crashed the car. What we need are proactive solutions, ways to prevent these crashes from happening in the first place. Section 6. Critics cry foul. Are the reforms enough? Spoiler alert, the critics are not happy. They're like that one friend who always has something to complain about, even if you just handed them $1 million and a lifetime supply of pizza. They argue that the reforms put in place after SVB don't go far enough, that the regulations are too weak, the oversight is too lax, and that we're just setting ourselves up for another financial crisis down the road. And you know what? They might be right. After all, the financial industry has a long and storied history of finding loopholes in regulations like it's a competitive sport. So while the reforms are a step in the right direction, it's important to stay vigilant and keep the pressure on to make sure they're actually working. Section 7. The regulators strike back. New rules for a post-SVB world. Regulators, those brave souls who dedicate their lives to making sure the financial system doesn't implode, have been hard at work since the SVB collapse. They've been crafting new rules and regulations designed to prevent another disaster. These new rules are like the financial equivalent of putting a bunch of safety features on a roller coaster. They might not be as fun, but they're designed to keep everything from going completely off the rails. We're talking stricter capital requirements for banks, increased oversight of risk-taking activities, and enhanced stress tests to make sure banks can weather a financial storm. Of course, these new regulations are not without their critics. Some argue that they're too burdensome, that they'll stifle innovation and economic growth, but hey, at least we're trying, right? Section 8. Banks. Between a rock and a hard place. Banks, those lovable scamps who just want to lend you money and charge you exorbitant interest rates, are in a bit of a pickle these days. On the one hand, they're being told to be more careful with their money, to avoid risky bets, and to generally act like responsible adults. On the other hand, they're also being told to lend more money to businesses and consumers, to stimulate the economy and keep the wheels of capitalism turning. It's a tough balance to strike, and it's no wonder that banks are feeling a little squeezed. But hey, that's what happens when you're entrusted with the public's money. So, the next time you walk into your local bank, spare a thought for those poor bankers. They're just trying to do their jobs, navigate a complex regulatory landscape, and maybe, just maybe, make a profit along the way. Section 9. Dear consumers, don't panic. Yet. Practical tips for financial survival. All right, folks, it's time for some real talk. We've covered the collapse of SVB, the regulatory response, and the challenges facing banks. First of all, don't panic. Your money is, probably, safe, at least for now. It's always a good idea to be prepared for the unexpected. Diversify your assets. Have an emergency fund. Aim for at least 3 to 6 months' worth of living expenses. Live below your means. Spend less than you earn. Stay informed. Section 10. The future is uncertain and possibly on fire. Cybersecurity, crypto, and other financial nightmares. The future of finance is uncertain. Cybersecurity threats are increasingly sophisticated. Cryptocurrency remains volatile and largely unregulated. Stay informed, be prepared, and invest in good cybersecurity. Conclusion. SVB. A wake-up call or just a bad dream? So, there you have it. The rise and fall of Silicon Valley Bank, a cautionary tale of risk, regulation, and the importance of not putting all your eggs in one basket, especially if that basket is woven from highly speculative tech investments. Was SVB a wake-up call? A sign that we need to fundamentally rethink the way our financial system works? Or was it just a bad dream, a temporary blip in the otherwise smooth functioning of global capitalism? Honestly, it's probably a bit of both. The SVB collapse exposed real weaknesses in our financial system, weaknesses that need to be addressed if we want to avoid a repeat performance. But it also showed us that the system, however flawed, is surprisingly resilient. It can withstand shocks, adapt to changing circumstances, and continue to function, even when it feels like everything's about to fall apart. The key takeaway? Stay informed, be prepared, and don't panic. And maybe keep a close eye on your local bank, just in case. US